Good day, everyone, and welcome to this special due diligence webinar. The format for today is a presentation with Q&A breaks throughout, as we want to make this event as interactive as possible. So please ask questions via the Q&A box at the bottom of your screen, and we'll endeavour to answer as many questions as we can. Today, we'll be discussing the MoneySpot investment fund. With a history of high returns, it makes a lot of sense to make MoneySpot part of your investment portfolio. I'd like to welcome Anthony Cullen, who represents the MoneySpot Investment Fund. Welcome, Anthony, and over to you.
Thanks very much, Paul, and hello, everybody, and thanks for joining us today. Today, our presentation will cover who and what the MoneySpot Investment Fund is, what we do, how we do what we do, the markets we operate in, our history of outstanding performance, how we deliver consistent returns. We'll look at a comparison with some similar credit funds. We'll look at our future growth prospects and how you can invest in the fund. In order to understand how the fund continues to deliver, it is essential to look closely at the underlying business. Today, I will share with you the business processes, policies, and systems that deliver our results of growth and consistent performance. We will take questions from the floor during the presentation. Next slide, please. Firstly, some important general advice warning. This presentation is not investment advice. It is presented for information purposes only. The material presented doesn't take your personal circumstances into account, and it is not an offer or an inducement to invest. You should consider the product disclosure statement and target market determination on our website and consider obtaining professional investment advice tailored to your specific circumstances before making any decision to invest. Past performance is not necessarily indicative of future results, and no person guarantees the future performance of the MoneySpot Investment Fund. Next slide, please. MoneySpot Investment Fund is a registered managed investment scheme, accepting investments from retail and wholesale investors alike. Our website is www.invest.moneyspot.com.au, where you can find all required disclosure documents, performance reports, and application forms. We lend, you invest. That captures what we do. Marketplace lending is a term used to describe advancing small to medium-sized loans to people who want money quickly and who want to repay those loans quickly too. Interest and charges are paid on top of the loan amount advance. We use investors' money to fund our consumer lending. The MoneySpot Investment Fund provides investors access to high-returning consumer loans. This is a segment of the credit market that is difficult to get direct access to. Consumer credit market is traditionally dominated by the major banks, as it is so profitable. So investors traditionally could only gain access through holding shares in those banks. What is it that we actually do technically? The MoneySpot Investment Fund invests in unsecured loan notes issued to MoneySpot Finance. MoneySpot Finance, in turn, lends money to consumers, small to medium-sized loans over short repayment timeframes. MoneySpot Finance is a profitable business generating excellent returns, enabling it to consistently meet the coupon rate of the notes on issue to the fund. In turn, the MoneySpot Investment Fund has been able to consistently meet its targeted returns for more than 6 years. What is our investment strategy? At MoneySpot Finance, we have 3 distinct unit classes available to investors. Class A is our longest established unit class with a minimum investment of $1,000 and a term of 6 months. Class B has a minimum investment of $250,000 and a minimum commitment term of 12 months. We also have a wholesale Class C units. They have an entry point of $2.5 million and a 24-month time commitment. All unit classes are invested in the same pool of consumer loans. There is no segregation of unit classes at the loan portfolio level. As is usually the case, a larger investment over a longer term carries higher target returns. Our investment strategy. We are simply a one-trick pony. We do what we do, and we do it well. Consumer lending is for small to medium credit contracts with short repayment schedules. We have a large and diverse consumer borrower base. We use efficient technology. We mitigate our risks through sound and responsible lending in regulated markets. We operate across multiple jurisdictions. All investment transactions are in Australian dollars, with currency risk, if any, absorbed by the operating business. Next slide. MoneySpot Investment Fund. A quick snapshot of this would be 150,000 plus consumer credit contracts, a pool of 400,000 plus live customers. The business is managed by accredited staff using detailed assessment criteria for loan approvals and loan management. The fund was established in April 2017. It's independently administered by one investment group and perpetual corporate trustees. Next slide, please. MoneySpot was founded by David True and David Spessert in 2013. Both gentlemen bring many years' experience in financial services. Both founders are active in the day-to-day operations of MoneySpot, setting and delivering on the strategic direction of the business. There is a passion for customer-centric continuous improvement at MoneySpot. This is capably led by the founding directors. Next slide. MoneySpot Finance, the business itself. MoneySpot is a high-volume, small-amount lender that provides loans to consumers who require prompt and efficient approval and settlement processes. Our systems are well-developed and deliver great efficiency and speed in decisioning. We have a high level of repeat customers. We manage tight approval, settlement, payment and collection processes that underpin the performance of our loan book, which generates excellent returns on the loans advanced. We have automated follow-up by SMS, email, and voice messaging, enhancing our efficiency. MoneySpot Finance only operates in regulated consumer credit markets. We do so for certainty for us and for you as investors, and of course for our customers. There are no grey areas on regulated consumer loans. All aspects of regulated loans are clearly outlined by the respective regulations in each of our markets. Next slide, please. A lot of small loans add up to a lot of money being lent out. MoneySpot Finance settles up to $50 million each month in new loans. Across our operating markets globally, our average loan is less than $1,000 and it is repaid over approximately 14 weeks. Next slide. Application or deal flow is generated through our established brands or channel partnerships to optimize web traffic to our lending application sites. There's a very good chance that if you type in a search criteria of short-term or quick loans, you'll end up at MoneySpot Finance to be assessed. These arrangements are fast and effective and drive efficiency in the cost of acquisition for loan originations. Next slide, please. I'll now provide you with insight into how we process our high volume of credit applications and how we manage the loans once they are settled and repaying. How do we assess credit applications, receive repayments, and follow up arrears? Everything is online. Today's consumer is after efficiency, value for money, and quick service. Most of our customers use smartphones to interact with us. We have apps available in Google Play and Apple stores, of course. Next slide, please. MoneySpot meets the consumer demand of flexibility and efficiency. Applications can be made at any time of the day on PC, laptop, tablet, or smartphone. A connection to the internet is all any person requires to start an application for a loan. We operate to our customers' convenience by providing our service on a 24-hour, 7-day-a-week cycle. We analyse the applicant's credit file, not just credit worthiness or past history. We assess credit reports for inquiries made, current and past indebtedness, defaults to creditors. We do not base lending on any raw credit score from reporting agencies. We do our own assessment work. The applicant provides us with access to bank statements in real time. We review at least the last 90 days transactions. MoneySpot assess income and expenditure patterns over that time. Running analytics, around 300 decision points are touched for affordability and reliability of the customer. All our decisioning is through the lens of responsible lending, a hallmark of ensuring repayment affordability for our customers. Next slide, please. All applications are online. We do not have shop fronts or agency outlets. We use sophisticated and highly reliable analytic tools developed in-house that drive the credit approval process. Our system can handle very large volumes in a robust and timely manner. We assess all applicants on their ability and willingness to repay their commitments. 85% of applications reach decision point within 2 to 3 minutes. This is a critical element in our success. Our systems are secure and reliable, with data protection and customer privacy following international best practice standards. Almost half of our originations are approved automatically. The rest are handled by person-to-person engagement, where we may seek clarifications or explanations or additional information in support of the credit application. Our largest operations centre is in the Philippines, and they work on a 24-hour, 7-day-a-week rolling shift basis, providing immediate response for customer interactions as and when required. Most of our customer connections are through SMS and email. Next slide, please. Each month, we process over 250,000 applications. That's not web clicks, it's completed and submitted applications. It's a lot of data to process, a lot of assessments to be made, and a lot of credit reports and bank statements to analyse. Every applicant has the same rigorous assessment process and lending criteria applied. Is their income confirmed? How and where are they spending their income? Do they have a decent credit standing? Can they afford the repayments? All applications are also washed through an anti-fraud database. Through all this, we approve up to 50,000 new loans every month. Next slide. At any given time, our loan book has 150,000 customers paying regular instalments to MoneySpot. This results in over 300,000 repayments each month, as over 90% of our customers are paying at least fortnightly. All repayments are via direct debit on the day customers receive their usual pay. We have more than 400,000 active customers who have borrowed in the last 12 months.
So, Anthony, maybe I've got a couple of questions here, so I might just step in for a second. First question here is, what is the difference between MoneySpot and the sort of buy now, pay later market?
Look, I think importantly, the critical difference here is we operate in a fully regulated market, and we only deal in regulated loan contracts, where we and our customers are fully aware of our respective rights and responsibilities, including practicing responsible lending frameworks as per, in Australia, the NCCP Act, and in accordance with other jurisdictions' responsible lending criteria as well.
Gotcha. And then with so many payments being processed each month, what is your direct debit clearance rate on the first presentation?
On first presentation, the clearance rate is over 90%. And many of those customers, the payment will be rescheduled automatically, but many of those customers will self-rectify within the next few days through the available, the tools that are available on the application for them to do so, on the website, and the app.
Fantastic. That's all I have for now. Let's carry on.
Thank you. Next slide, please. If there was ever such a thing as an average or typical customer in Australia, MoneySpot customers are, on average, earning around $70,000 a year. They've been in the same job for more than 12 months. They have steady and stable income stream. They have a decent credit history and have an average repayment of less than $150 for the repayment cycles. Next slide, please. Looking at the demographics, 2/3 of our customers are 35 years of age or under. Male and females are equally represented, and they mostly live on the eastern seaboard. We are not overly exposed to any one demographic. Our customers' diversity is a key strength in mitigating risk. We have lots of small loans spread over a diverse customer base.
And so I'm just going to jump in again. Just a quick question here, regards to that slide. Are your customers concentrated in any particular job type or industry?
No, they're really not. No one industry has a concentration of over around about 8%, I believe the latest numbers were. And it is interesting that we seem to be a fairly equal mix of white and blue collar workers, Paul. And interesting to say, we generally say our borrowers are literally everyone.
I'll let you get on.
Next slide, please. A really, really important factor for us in the success to date of MoneySpot is that our customers come back to us. Our customers like our product. They come back to us regularly. Over 80% of our new loans are to previous customers. Know your customer, KYC. It's a commonly used catchphrase in banking and finance. With such a high level of repeat business, we have a very good understanding of who our customers are. Most of our new loans are to people who we have first-hand experience with, and we absolutely know their capacity and, importantly, their willingness to repay loan commitments. This further reduces our risk. We make repeat business easy for our customers. Whilst we thoroughly assess all new applications, returning customers have much of their data already on file, so it is only updates and new access to the most current bank statements that we require when they're coming back to us. Our customers generally use our loans to cover temporary shortfall in expenditure. Loans are for a variety of reasons, from unexpected repairs, dental work, medical bills, car maintenance, and those sorts of things that crop up on a day-to-day basis for people. Our customers like the efficiency and the convenience of our loan process, especially our speed to decision. We provide certainty in their money requirements. Next slide, please. Here in Australia, which is our most developed and long-term market, on average, our customers borrow from us twice a year. They are time poor and technology savvy. They expect prompt and efficient service for all their needs. Short-term lending is no different for them. We are fast, we are efficient, we are consistent in our approach, and we are simple to use. Our customers like having a defined start and end date for their loan contracts as well. This has advantages over an open-ended credit card extension for shortfall or unexpected expenses. Our customers are willing to pay a premium for the convenience of our product. Our ability to deliver a seamless and fast service is an attractive proposition to our customers. Our customers see our fees and interest charges as a service cost they are willing to pay. Next slide, please. Where do we do this? Our head office is here in Sydney, where we conduct our day-to-day operations in Surrey Hills. In the USA, we have a country head office based in Los Angeles. We have loan originations in the USA and South Africa, and operational centres for customer service and administration in South Africa, in India, and in the Philippines. South Africa is a long-established market with good historical growth and performance. The USA is a key growth market with approximately 40% of new loans originating in the USA last month. Next slide, please. The USA market continues to offer great potential for growth with new state markets opening up over the last 12 months. Texas is our longest established market with operations beginning in July 2020. Florida, Texas, and California are very large states with significant populations. We have access to a large consumer population in those and our other approved markets. Next slide, please. Our consumer credit contracts deliver us a high yield. Our small amount credit contracts, that's those loans under $2,000, have a 20% establishment fee and a 4% of loan amount monthly fee. A medium amount credit contract, $2,000 to $5,000, have a maximum establishment fee of $400 and an annual interest rate of 48%. Our loans are repaid, however, on average in 14 weeks. This means our whole loan portfolio turns over 3.7 times each year. We achieve a high net interest margin of more than 80%, delivering our profitability and in turn, our consistent return over many years. Our loans are applied for, settled, and repaid in a significantly shorter time than the minimum commitments of our invested funds. That does differentiate us from other such credit funds. Looking at originations growth over the last 5 quarters, you can see we have written nearly 330,000 loans from July 2022, valued at $458 million, an average of around $1,400. Since inception, the MoneySpot business has provided more than 1 million loans, advancing over $1 billion to our borrowers. Australia, where we now write predominantly medium amount credit contract, that's those between $2,000 and $5,000, as a result of regulatory changes in June this year. This will see the overall loan size continue to increase in Australia. The business yields significantly higher than required to meet its coupon rate on the notes on issue. It is our key to being able to consistently meet our target returns across all unit classes. Non-performing loans have had very little impact on our ability, have had no impact on our ability to meet our commitments in actual fact, and they are within tolerance levels well and truly.
Before we go on, Anthony, you're going to jump in again. It's got a question here. The question is around what are the key reasons you consider your unsecured consumer credit loans to be an acceptable risk for investors?
Well, Paul, I think as demonstrated, our loans are small amounts. They're repaid in a short period of time. They're repaid by direct debits taken on each customer's payday. And we have sound credit policy and sophisticated assessment tools that provide us with a good level of insight into our customers' ability and, more important, willingness to repay their loans. The frequency of the repayments also provides us with a real-time problem solving. Most of our payments are on fortnightly or less cycles. Therefore, we know very soon if a customer is in some form of trouble, and we can intervene and follow up and take the appropriate action at that time. All of those issues, I think, reduces the risk that you might, without knowing about the business, think that a consumer credit portfolio would carry with it.
And there's a question here from the audience. They also noticed that the bad debt levels, there's been a slight increase over the last three months. Is that a trend that concerns you, or just a set of circumstances, or seasonal?
Look, the business manages it on a day-to-day basis, obviously, but it's also indicative of the fact that the fund is growing. We talked about another 330,000. The credit portfolio is growing. 330,000 loans with hundreds of millions of dollars. When you're in a growing loan book, the time to pay also is increasing here in Australia with the length of the loans. So you will get those fluctuations, but they're well within the tolerance level and well within affordability when it comes to the very high net interest margin that the business does operate under.
Thanks, that's it. I'll let you carry on.
Next two slides, slide 28, please. As is demonstrated, there is a history of stability and consistency here with the actual returns versus the target returns over the last 5 years for our Class A units. There's hardly any movement in the performance over the 5 years. Indeed, since inception, the fund has returned at or above its target rate consistently. The Class A units have consistently met that target of 12.8%, which is demonstrated by the blue line on screen. Achieving consistency in performance isn't particularly easy to do. It is, however, not overly complicated to achieve either. We do so by managing a high-yielding and profitable consumer credit portfolio that is attractive to our customers, that provides a reliable, quick and effective service. All our loans are regulated. We don't look for loopholes like buy now or pay later. We don't do credit cards. We don't offer large or long-term loans. We do not do long-term auto or equipment lending. We stick to what we know, small to medium credit contracts over short time horizons to reliable customers who are willing and able to meet their commitments. Essentially practice responsible lending, which leads to repayment regularity from customers. Having a look at the MoneySpot Investment Fund performance across all asset classes over the last 5 quarters, the same stability and consistency is demonstrated as with the Class A we just looked at. Each unit class has achieved its target returns across the 15 months reported here. All classes are exposed to the same consumer credit loan portfolio, as I mentioned before, and there is no segregation with that. Class A units don't at a particular part of the book, or Class C or Class B. It is all one loan pool. The high-yielding consumer credit portfolio underpins the returns achieved across all unit classes. The fund website has every performance report since inception, and together you can look at all the required disclosure documents, of course. Next slide, please. The fund has grown to $96.4 million at the end of September 2023. The majority of the growth over the last 5 quarters has been in the wholesale unit class, with a high entry value of 2.5 million and a minimum term of 2 years. The targeted return in this class is 20%, and it too has been consistently achieved. The growth in Class A and Class B has been solid, and net inflows each month demonstrate that many of our investors choose to leave their money in the fund beyond maturity dates. MoneySpot has not missed a redemption since inception, and given the positive cash flow and profitability of the operating business, the fund is in a good position to continue to meet its redemptions as they become due. The fund actively manages its cash flow and redemption requirements, understands the potential redemptions falling due, and communicates regularly with its investors regarding their intentions before maturity dates.
Got a couple of questions here, and the first one I would have asked myself if it hadn't come through from the audience is, look, those performance figures are pretty impressive. How do you consistently deliver the returns you do each month?
Well, again, I think it's the short-term and high-yielding nature of the loans that we actually have in our consumer loan book, Paul. We provide, they give us the very high net interest margin that we need to ensure the business is profitable and able to meet its commitments to the fund. Our loan exposure is spread across thousands of individual borrowers, reducing the risk of loan default to any significant degree in the portfolio.
Another one here, this person saying, if I leave my investment in the fund after the maturity date, am I required to wait for a further maturity period again before redemption?
Yes, that's how it does work for us. We will notify you a month before redemption, the redemption anniversary, and we'll accept your request to redeem in that window at any particular time. And if you choose to do nothing, we'll automatically roll over and it'll go for a new term in the relevant class that you're in. But of course, we're always talking to investors, and we do know when these things are falling due.
Gotcha. I'll let you carry on.
Thank you, Paul. Next slide, please. Look, it's difficult to get a direct comparison with what we do and what the MoneySpot investment fund does. But if you look at if you look at some products with low entry points and similar maturity or redemption periods, we can have a look at the very successful and well-regarded MA Priority Income Fund and La Trobe, of course, one of their particular classes. Both of these funds have a diverse book of loans that are generally based on real property or other tangible assets, back lending. And so they're clearly different profile than the MoneySpot Investment Fund. Each of the comparison funds, though, have underlying loan assets with maturity dates well outside investment maturity terms. In contrast to MoneySpot Investments, which has underlying consumer credit contracts that are significantly shorter times than than all of our investment maturity terms, with that 14-week average versus the minimum term of 6 months for the Class A. MoneySpot Investment Fund returns are higher than might otherwise be expected, given the stability, yield, and profitability demonstrated today in the consumer credit portfolio we operate. It is well managed, obviously, and has successfully mitigated risk over a long time frame. Next slide, please. Where are our growth opportunities? Our growth opportunities are coming here in Australia with organic growth. We're still growing at around 60% in the Australian marketplace. So there's clearly a need for our product and a desirability of our product. Those loans in Australia will be in the predominantly in that medium amount credit contract that we talked about before. We understand the high yielding nature of the business in Australia very well, and we've been doing it for a considerable amount of time. As far as our growth opportunities internationally, we continue to work in the multiple jurisdictions across the USA. We're generating 40% of new loans written with the new licenses coming online over the last 12 months operating in the US. By the end of this year, we expect to have an even greater amount of exposure to a large base of population in the US. And the loan portfolio in the US itself delivers higher returns than Australia, with a smaller loan amount over shorter terms, resulting in higher yields than here. We're continually exploring other stable jurisdictions with regulated consumer credit markets to launch our proven lending model in those.
There's a
Next slide,
question.
please.
There's a question here, Anthony. It's actually back to slide 31 that goes those competitors. When comparing to that MA Priority Income Fund, what is the key difference in your respective loan portfolios?
I think one of the differences is our loan portfolios are created by us. We manage the application, the life of the loan, the collection of the loan from woe to go. MA Priority Fund purchases loan books that are on foot, that have been analysed and assessed by others. Obviously, they do their own analysis and assessment, but that is probably one of the key differences. We create, they've purchased loan books.
Gotcha. Thank you. Carry on, please.
Thank you. Where are we? Next slide, 33, please. Again, we're looking at the difference in returns for our loan rates. The different classes of investments that we do have are the Class A, Class B and Class C investments, and they range from 6 months all the way up to 2-year commitment. Our Class A and Class B investments are available to retail investors. Class C is a wholesale-only product. Applications are processed weekly. We have minimal initial investments of 1,000, 250 and 2.5 million, and minimal additional investments, again, of 1,000, 25,000 and 250,000. So those higher unit values there, we're talking about around 10%, well, it is 10% of additional investments. And the minimum balance required is from the minimum buy-in amount of 1,000, 250,000 and 2.5 million. We distribute our returns on a monthly basis. Obviously, the difference in return targets is for different commitments and higher dollar values invested in time in the fund.
There's a couple of questions here, Anthony. A question coming in here. Are you dealing with advisors currently? And if so, who are they?
Yeah, well, look, we are dealing with advisors currently. We've recently been granted access or approval to the Wealth Today Financial Group APL, and we're receiving applications from various advisors across that group. And there was previous experience in the early days of the fund with the Spring Financial Group as well, where advisors have had their clients' money in the fund for some period of time. Yes, so we are also talking to other groups about getting onto their approved product list to enable their advisors to also recommend the fund.
And is the MoneySpot Investment Fund research rated yet?
It is research rated, and we have SQM research with a 4 3/4 star favourable rating, and that was published in December 2022, and we're in the process of completing the updated review as we speak.
Thank you. You can carry on.
Next slide, please. Today, we are announcing some bonus offers available for wholesale investors only through this webinar as an opportunity to attract some more investment through your stakeholder group, Paul. Thank you very much. So the bonus program, we will offer an additional 1% targeted return on the Class A and Class B units with the same investment terms and the same minimum investment amounts. So again, that is, we will look for a targeted return in the Class A units of 13.8%, and that will be a minimum $1,000 investment. And in the Class B, we will be targeting a 15.8% return with a minimum investment of $250,000, respectively for 6 and 12 months for both those funds. Next slide, please. The offer announced today is for wholesale investors only. And an up-to-date accountant's letter will be required to participate in the bonus target returns. Expressions of interest to be registered at www.invest.moneyspot.com.au/wholesale offer. We will be delighted to have you join us as invested in the MoneySpot Investment Fund. We do handle a large volume of small loans, spreading our risk over a very large and diverse customer base in Australia and overseas. In summary, the MoneySpot Investment Fund and its underlying business is reputable, stable, has a proven operation that has met or exceeded its targeted performance over a period of more than 6.5 years. Thanks for listening today. I'd be delighted to take any questions you may have from the floor.
I think you exhausted all the questions, Anthony, but many thanks for your presentation and many thanks to everyone for tuning in today. Details of that offer that Anthony talks about will be on our website and make it readily available to everyone that was on to today. So, Anthony, thank you for your time.
Thank you, Paul.
And once again, thanks everyone for tuning in for another special due diligence webinar. Have a great afternoon. Thank you.